Hey guys, what is going on? Welcome back to episode 10 of Inflation Report. And this episode, wow, what an episode. So much has gone on in the last few weeks. So much macroeconomic news, big news, some big CPI prints. So let's go through all of that together now in this episode. So then let's move to our first slide. So UK CPI. So here we can see in the chart in front of us that UK CPI has reached a 40-year record of 9.4%. A 40-year record of 9.4%. Now this is the highest inflation rates have been since 1982, which is shocking when you think about it. We've had 40 years since we've had rates this high. So, again, what's the key driver of this? Well, I could go into all the metrics like I've done in previous videos, but it takes a little while. I think all of us by now in the UK, we understand that this is to do with energy, to do with rent, to do with food, transport. All of these things, we're seeing it in our faces now. Very, very high, 9.4%. And people, this is the time now, people were starting to say, hey, base effects from 2021 are going to start to come into play. What do we mean by base effects? Well, we mean that if you look at June 21 in the graph, the CPI rate was 2.5, which is already quite elevated against historic levels of sort of sub 1% CPI. 2.5 was already deemed, this was quite high. So the base effect of that should soften year-on-year increases, because we already did 2.5% year-to-date June 21, or year-to-date June 22, 9.4%. So if you aggregate that over the 2 years, you're looking at almost 11 or even 12% inflation over that 2-year period, which is massive. So highest since 1982. Now, in 1982, interest rates in the UK, the Bank of England base rate was 10%. 10% interest rates in the early 80s. Now that would mean your mortgage would be roughly 12%, 13%, depending on other variables. So can you imagine today mortgage rates 12, 13%? It's just not thinkable. We can't imagine it. Is it possible? It's possible. Is it likely? I would say it's unlikely, but we've got to be prepared for these sort of financial circumstances and situations. So we note as well, big news, the Bank of England raised the central bank rate from 1% to 1.25%. They did that on June the 16th. They raised the base rate by 25 basis points, or 0.25%. And they've done that. They say they're trying to control inflation. Well, friends, we know from this channel that you're unlikely to make much of a difference if the base rate is 1 or it's 1.25. Either way, that is unlikely to really impact headline CPI. It's just too small a difference. And also we learned from the hike in June, the 25 basis point hike in June, we learned about the appetite of the Bank of England to raise rates. The fact that they've only done 25 again, and in response to these huge numbers, the nine handle on inflation, they're still only moving at 25 basis point increments compared to the US. The US have now done 2 consecutive rate hikes of 75 basis points. There is not much appetite to raise rates in the UK. That is the signal that I'm taking from this move. Now, could rates continue to go up 25 bips a month? Of course they could. Could they go higher? Of course they could. But the signal we're getting is that the appetite is not really there. So what do we conclude about inflation in the UK from where the interest rates are, where the inflation rate is, where the efforts of the central planners are to combat this? We conclude that there is danger here, friends. There is danger of runaway inflation. And I really mean it. There is a risk of that. Again, is it a likely risk? Are we likely to see hyperinflation? Well, I think at this stage it's low likelihood, but the danger increases. The longer they leave the inflation beast to grow and they don't kill it whilst it's small and in its infancy, the higher the probability of a runaway inflation. Okay then friends, US headline CPI. We see that the US June headline CPI, 9.1%, 9.1%, and below that we've got what we call the shadow stats graph. Now this is because it's commonly understood that the CPI has been tweaked and tuned and fettered with over the years so that the calculation is not as it was back in the 80s and the 90s. You think of the hedonic adjustment, you think of the quality adjustments, you think of all of these tweaks that governments have made to the formula to make it less comparable to prior periods. Is it less accurate? Well, I have the opinion that it's less accurate, but we will see. So what we can see here, the red line is the reported CPI, the blue line is the shadow stats 1980s based alternate CPI. So this is if we calculated CPI in the US as the governments did back in the 80s, and we can see that the headline rate of the red line is 9.1%, but the shadow stats 1980 alternate rate is now looking at about roughly 17%. That's right, 17%. And I think what we need to do is we need to go to our bigger time frame chart to understand the significance of this 17%. So I'm just going to go over to that chart here. We have the US inflation chart. Now we can look at these peaks in 75 and this other peak in 1980. The peak in 74, 75 was 12% inflation. The peak in 1980 was 15% inflation. So if we are actually at 17% CPI, according to shadow stats in the US, then we are at historic levels of inflation that have not been seen since the end of World War II in the 1940s. This is the significance of the rate of inflation we are dealing with. It is a very serious and a very high level of inflation. And if we come back and we look at what we were talking about on inflation report 12 months ago, and even over the last 6 months, we were predicting this sort of inflation, and that prediction is coming true. We're seeing these historic high levels of inflation. So in conclusion then, what is really the issue here? Well, the issue here, friends, is that inflation is a problem that is not being dealt with. The governments are not nipping this in the bud. And that is dangerous because, as they say, you need to kill inflation whilst it is small, and it can be killed. Otherwise it becomes a monster that is enormous and it can't be killed. And you end up with a Zimbabwe Weimar. You know the deal. Now what I want to say here is, do rates need to go to 10% like they were in the 80s? Well, not necessarily, and let me explain why. Everything is relative. The economy now is far more sensitive to a delicate change in rates than it was 40 years ago when we were less sensitive. And why were we less sensitive 40 years ago? Well, in the UK and in the US, the debt to GDP ratios were lower. We had more scope to we had less indebtedness, which means we were less sensitive to the change in the cost of borrowing. Whereas now the economy is so geared up, so levered up, so much debt, that even the slightest change in borrowing cost can throw things overboard and bring down demand consequently. So we are more sensitive to moves in interest rates. However, I still feel that these rates, we're talking in the UK, inflation at 9.5%, bank rates at 1%, you're talking negative 8% real rates, which is still a massive negative real rate. So the inflation problem, in conclusion then, is not being dealt with. And so then let's move on to the next slide. Okay then friends, so our next big news is that Boris is out. Boris resigns as Prime Minister on the 7th of July. And we know that either Liz Truss or Rishi Sunak will replace him. And I've spelt Liz Truss's name wrong. Let's do her justice. There we go. Liz Truss or Rishi Sunak will replace Boris. Now, I have painfully listened to the prime ministerial debates, and that is Actually, it was relatively interesting because it was I was looking for insights into economic policy. How will each of these prospective leaders deal with inflation? Most importantly. So let's go over their comments and look at some of their comments. Let's start with Rishi. Rishi's comment, you can see it there on the screen. Rishi says, dealing with inflation is a top priority. Dealing with inflation is a top priority. So the question is, it's all good saying this, Rishi, but what will the actions be that actually deliver on that top priority? Now remember, how do we tackle inflation? How do we tackle inflation? Well, we can raise interest rates. Of course, Rishi's not able to raise interest rates. That is Andrew Bailey, Governor of the Bank of England, who has he is the chair of the Bank of England, essentially. He is the one who can influence where rates go. I believe it's a committee decision, but he heads up that organisation. So we can raise interest rates. Certainly, Rishi can put pressure on the Bank of England to raise interest rates. Will he do that? Maybe. Who knows? He did make sort of some signals about that in his debates. He talked about when he was trying to accuse Liz, he would say, look, if you go down the path of Liz and you borrow more money, which we'll get to that in a moment, but you borrow more money, that's going to result in higher interest rates because of inflation. So Rishi was making the right sort of noises, indicating that higher interest rates are a possibility. And so then what else could he do? Well, he could reduce government spending. Now, many Western governments, G7 governments, tend to just run deficits. They spend more than they collect in tax revenue. Why is this inflationary? Well, it's because they fund their deficits by issuing debt. They are major borrowers of money in an economy. So they could reduce government spending, and that would reduce economic activity and therefore would reduce demand, which would be good for fighting inflation. Are governments likely to reduce spending? I think probably not. Maybe relative spending against the COVID years, but I think generally speaking, governments like to deficit spend. It's very unlikely you'll see a sudden return to surplus activity. And finally then, maybe he could increase taxes. This is how he could fight inflation. Rishi could increase taxes. Now this is very unpopular, but the way it would work is you increase taxes on the middle class. They've got less money in their pocket, therefore less demand. You know how it goes. Less demand, less inflation, in theory. And that would be highly unpopular at a time when people are really struggling. Inflation is causing people to struggle, and the governments is almost a paradox, because the governments need to tighten conditions. They need to take money out of people's pockets to reduce demand and reduce inflation. But at the same time, they want to put money into people's pockets so that they can handle the cost of living crisis, and they want to keep people happy. And that's a very dangerous thing that we see in the attitude of people today. We see in the attitude, especially in the UK, we want the government to give us free money to get us out of this cost of living crisis. And it was a bit like when the lockdowns happened, where is my furlough paycheck? Where's my government bailout? Where is it? And friends, these are inflationary policies, and the piper has to get paid, right? So you can't demand free stuff and then moan that there's higher inflation in the future. This is what happens when everybody gets a handout. You have to pay for it later down the road for inflation, the inflation tax. So that's a bit about Rishi. Rishi says dealing with inflation is a top priority. But let's look at Liz. Now, Liz sounds rather concerning, some of the things she was saying. She is promising tax cuts on day one. Tax cuts on day one. Sounds good, doesn't it? Tax cuts. More money in people's pockets, more money to cover the cost of living crisis. However, more money in pockets means higher demand for goods and services, and higher demand for goods and services will exacerbate the inflation problem. So, unfortunately, when it comes to inflation, generally you need to swallow the foul-tasting pill. You have to have that foul-tasting medicine is the remedy for reducing inflation. And we seem, again, it's our attitude, unwilling. Politicians are unwilling to say, sorry guys, sorry nation, but we've got to go through some hard austerity. Otherwise, we're going to have an even worse inflation crisis. And it's this short-termist attitude. We'll try and cover up the next 12 months by handing out free money, and we'll worry about the next 12 months when the time comes, which is really what we're seeing now. So Liz wants tax cuts on day one, money in people's pockets. Now, the problem with tax cuts is that's a double whammy, because not only are you putting money into people's pockets, which they're going to spend, but you're also leaving a hole in the government finances. Where is the government going to get the money from that they've lost in tax revenue? How are they going to get that money back? Well, they're going to borrow it. And she is proposing that we borrow money and we spread it out over into the long term. And of course, government borrowing, deficit spending, we know this is inflationary pressure on the economy. And then the concerning thing that Liz said, and you can see it on the screen, Liz says, our debt to GDP is not as bad as Japan or the US. She says our debt to GDP is not as bad as Japan or the US. Now, friends, this is not the right way we should be thinking about our debt to GDP. And if you think about somebody who has, an alcohol problem or a drug problem, and this is a good analogy for addiction to borrowing money to pay for government. The politicians just want to borrow, spend. It is like the drunkard who just wants to drink, more and more and more. Or the drug user, they just got to take more and more drugs to get the same high. Now, you think about this, she is comparing the UK debt to GDP to nations that have really bad debt to GDP, like Japan, which has a debt to GDP crisis, and the US. And that's like looking, as a drunkard, looking at that other drunk person who's way more drunk than you are and saying, oh, we're not as drunk as they are, so we need to get more drunk. Or looking at that guy who's completely hooked on hard drugs and saying, well, we're only hooked on certain weaker stuff now. We need to get hooked on the hard stuff like those guys. It is the analogy of the cleanest dirty sheets. We say our balance sheet is like a dirty sheet. Oh, but look how dirty those sheets over there. They're even dirtier than we are. That means we have scope to become more dirty. Well, no, we don't. You don't want to be a dirty sheet. You want to be a clean sheet. You want to have a healthy balance sheet, healthy economy, healthy debt to GDP. So this was concerning what she was saying. She's looking for a quick way out, an easy way out, a politically palatable way out. It will work in the short term, but in the long term, it will create more and more problems, more and more fiscal and economic problems. So in summary then, Rishi is signalling that he wants to fight inflation, but will he? Will he have the courage to actually stand up to it? And Liz seems less likely. She seems more open about trying to paper over the cost of living crisis by just giving people handouts and tax breaks. Okay then, friends, finally we're going to close this episode with some quick thoughts on Nord Stream 1. This is another big story that has been developing over the last 4 weeks in particular. So what is Nord Stream 1? Well, it is the main pipeline between Russia and Europe. It connects Russia to northeastern Germany. It's controlled by Gazprom, which is basically controlled by the Russian state. And we know that there's another pipeline called the Yamal pipeline. And we know that the Russians, they closed the Yamal pipeline in May. And then what did they do to Nord Stream 1? Well, in Nord Stream 1, in early July, it went down for maintenance for 10 days. They switched it off, 10-day maintenance. Did it need maintenance, or is this just a bit of a reverse sanction from Russia? Only they know the truth. But what happened after that? Well, it went down for maintenance. And then on the 27th of July, after it had come back online for a couple of days, the capacity or the delivery of gas was cut to only 20 cubic meters. I believe the capacity of that pipeline I've read is 170 cubic meters. So all you need to understand about Nord Stream 1, the key figure to remember, Nord Stream 1 is currently operating at 12% capacity. 12% capacity. This is natural gas coming from Russia to Germany, operating at 12% capacity. Now, gas in the UK the price is obviously affected by this, whilst nations in Europe, not every nation in Europe gets all their gas from Russia. Germany gets about 80%, or did get about 80% of their gas from Russia. And you say, well, we don't get our gas from Russia, so why is there an issue? Well, there is an issue because whatever is not being supplied to Germany by Russia, now Germany needs to go to the market and find that supply and restore that supply. So the local European market is raised, and we can read here, gas prices in the UK are up about 250% since July last year. So they're up 2.5 times since July last year. And we're feeling this, aren't we, in our pockets in the UK on the monthly energy bill. So this is no secret. Now the question is, as these pipelines are just starting to get turned off over literally recent weeks, how will the knock-on effect of that impact the economy? How will it impact German households? How will it impact German manufacturing, European households, European manufacturing? How will all these things be affected? And I'm no expert in this, but I've got some statistics that will help you start to think about this. And I truly think this is a massive story. I mean, you're seeing it in the news, but I think this is a huge story. And I just want to share some key statistics to help you understand the magnitude of this problem. So last year, Russia supplied the EU with 40% of its natural gas. So Russia supplies the EU with 40% of the EU's natural gas imports. That is a huge portion, a huge amount of dependence that the EU has on Russia. And another statistic then, of natural gas used in the EU, about 40% of it is used for residential purposes, and about 60% of it is used for industrial purposes. And this is what people need to understand. This reduction in gas is not simply, oh, my heating bill's gone up. You're talking about major impacts on industry. And if you think about Germany has massive amounts of manufacturing that goes on, huge energy intensive processes, and these are going to be massively impacted. And what happens if manufacturing businesses in Germany are impacted? Well, you're talking about layoffs, redundancies of staff who work for these places where output is going to have to come down. And generally speaking, you know, if output and productivity and all these things are declining, that is essentially a recession. You're going to have major recession in Europe because of this shortage in energy. So this is one to really watch. And if you combine the rising costs of everything with people losing their jobs, it's just going to be an absolute economic disaster. So you just want to watch very closely what is going on in Europe over the coming months. We will see, and I'll keep an eye out on it for you on this channel. We'll be reporting on the developments as they come. But Nord Stream 1 production, Nord Stream 1 volumes of gas flow are operating at 12% of capacity. Europe gets 40% of its gas from Russia, or at least it did before the war started. And that split of gas is about 40% residential, 60% industrial. So major industrial impact as well as household impact. So that's a wrap then. I hope you enjoyed this episode of Inflation Report. Do like and subscribe, and I look forward to catching up in the next episode. Bye bye.